Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
Welcome back to the Federal Drive with Terry Gerton on Federal News Network. Markets have been noisy for months, but when you look past daily swings, many TSP funds are firmly in positive territory, highlighting the gap between headline volatility and how markets actually price information. Certified Financial Planner Art Stein is here to help explain the disconnect and how investors should respond. Art, thank you so much for joining me.
Happy to be here, Terry. Thank you very much.
Art, it feels like we have been talking for months about market volatility, whether it's engendered by concerns about war or interest rates or other sorts of uncertainty. And yet, when you actually look at TSP returns, both stocks and bonds are up this year. So let me start with a basic question many federal investors might be asking. How is that possible?
Okay, well, how it's possible is a lot harder to say than the fact that it happened. And, you know, the market goes up and down for a lot of different reasons. And on a short-term basis, it may go up and down because of current events. And one thing I would say to TSP investors is if they look at returns for the first quarter through March 31st, which is what they'll see on the TSP website, they're like totally different than the returns they would see as of last Friday, which is just about 2 weeks or 2.5 weeks later. At the end of the first quarter, the C fund was down 4.3%. As of April 17th, it was up 4.5%. You know, that's a total turnaround. Same kind of turnaround with the S fund. It was down in the first quarter. Now it's up 8.5% for the year. The I fund has been a little more consistent in that it was up 2% in the first quarter, but it's now up 12% for the year. And we also saw a similar turnaround in the F fund, which was pretty much flat in the first quarter. Now it's up 0.9%. So it's been a lot of movement. And I was, when I was sort of getting ready for today's interview, I was going through, all these changes and everything that happened. And then I thought, all of this just happened in a 3.5 month period. I'm looking at this thinking, well, it's just, I'm looking at like a year or 2 years worth of changes and events, but it wasn't. It was just happening in a 3.5 month period. And so obviously we're going to see some ups and downs in the financial markets. One of my clients said, the market looks like it's going crazy. And I, went through my standard spiel that like historically the volatility is actually not that high this year. I mean, there have been a lot of years where it was more volatile during the first 3.5 months. And then I read a great quote by Jason Zweig in the Wall Street Journal. He said, the biggest danger isn't that the markets can go crazy, but that they'll make you go crazy. And I just thought that was perfect. I love that quote. And I'm not going to get it tattooed on my forearm, but I am going to use it again. That's it. This has been a good example of patient investors who don't react to, current events, really, and just stick with their investments, especially in the stock funds, have done way better than people who tried to move in and out in order to either protect themselves or to make a greater profit or anything like that.
Art, we often associate market volatility with losses, losing money. The backside of that, as you and I have also talked about, a technique called dollar cost averaging. Maybe walk us through that a little bit and how that can help people not go crazy, right, when the market is moving around so much.
Well, this is the advantage that employees have over retirees. Employees are investing every 2 weeks. There's a certain amount of funds from their paychecks go into the TSP, and that's dollar cost averaging. And they can afford One, because a small amount is going in every 2 weeks, but also because they're younger and have some number of years until retirement, to be much more aggressive with those biweekly investments than the overall allocation of their TSP portfolio. And I certainly encourage people that way. Like maybe you have half your funds, maybe your current funds are 50% in the bond funds and 50% in the stock funds, but your new money going in every 2 weeks, why not make that 80% into the stock funds and 20% into the bond funds? The market crashes, it's good for you because you're investing at a lower rate and it's going to increase your overall return as a result.
I'm speaking with certified financial planner Art Stein of Arthur Stein Financial. Art, let's come back to the movement in the overall market indicators and the TSP performance. Some people are saying that the market's priced in their expectations about, say, oil prices before some of the recent events hit. Is that what's happening here? Is there market information that's being transmitted through these prices?
Well, a lot of times, there will be a major event and the market will move in a different way than people expect. And that's because, a lot of major events, such as a change in the Federal Reserve's interest rate policy, are anticipated and in many cases pretty well known. And so the stock and bond markets react to what is expected to happen. And when it happens, you don't get much of a reaction, or you get the opposite reaction, anything like that. I would say that a lot of what's happened so far this year does not fall into that category. I think a lot of people thought we might bomb Iran, but I don't think they knew that we were going to do it. And then you had a ceasefire. And then you had the blockade of the Strait of Hormuz, which I think should have been anticipated, but many people didn't, certainly the administration, I think. And then the fact that Iran started bombing other countries in the Gulf and their oil facilities, and that's, going to reduce oil production for years. I'm not sure how anticipated that was. And then we had a truce, and then we didn't have a truce. And, I'm sorry, I don't think that even sophisticated investors would have known that was going to happen. Now, maybe there are some insiders who knew that, but this is just not a typical typical situation, what we're seeing now. I mean, the administration's foreign policy has been erratic.
Art, if volatility, like we're talking about in the market, is unavoidable, and you've sort of described it, it's going to happen. We may not know exactly why, but market's going to move. But in cases like this, positive returns are still possible. What should long-term TSP investors actually be paying attention to instead?
I think that they should be paying attention to when they're expected to be withdrawing funds from the TSP and how much they're going to need each year, and then base part of their allocation on that. I mean, if you're say a year away from starting withdrawals from the TSP, you might just figure out how much you're going to withdraw per year, estimate it roughly, and maybe take 5 years of withdrawals and put that in the G fund. So you don't have to worry about any volatility at all in that. And maybe take another 5 years of withdrawals and put that in the F fund, which is a bond fund, which does fluctuate in value, but not a lot compared to the stock funds. This is called a bucket strategy. So you have different buckets for your needs, your needs in the next 5 years and 5 to 10 years. But then for the money that you need to spend in the next 10, 20, and 30 years, I think you need to concentrate that into the stock funds. I mean, historically, it was only the stock funds that increase purchasing power over long periods of time, taking into account taxes and inflation. And, if you're retiring at 65, I mean, please assume that you're going to be retired about 30 years. Not everybody will be, but lots of us are going to live to 95 or above because we don't know which one of us is going to. We all need to prepare for that. And, if you die with money in the bank, you're not going to worry about that. But if you live without any money, if you're still alive when your TSP funds and other investments are exhausted, you are a miserable person.
I've been speaking with Certified Financial Planner Art Stein of Arthur Stein Financial. And Art, I really appreciate your clear-eyed reality and your wise guidance.
Thank you, Terry.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Listen to the Federal Drive on your schedule. Subscribe wherever you get your podcasts. Coming up next, how shared experience plays a role in helping people reset under sustained stress. This is the Federal Drive with Terry Gerton on Federal News Network.